All right, welcome back from the breakout rooms. So I'm going to go ahead and put up the Delta ROIC. So anybody want to practice or talk through this? Any volunteers?
I guess I can get started if someone wants to kind of hop in after me. But I guess to start, their end of year ROIC declined by 29.3% over the 5-year period. We see that most of that decline is in 2017. And so that should be kind of a point to note. Looking at the cash tax rate first, we see that the tax rate went down 37.2%. Most of that decreases in 2018. And so this is actually helping the ROIC. So we see that the problem isn't here. The problem is with pre-tax. So that should be where we focus. Looking at pre-tax, the pre-tax ROIC declined by 41.8% over the period. It was relatively steady. It's about 3 to 4% per year. There's more of a decline in 2018 though. So that might be a point of concern. And something to look further.
All right, can I stop you right there? So two things. One, you actually are connecting the dots and you're making some really good observations, but it's hard to follow because it's more clear to you than it is to me because you're not using numbers.
Got it.
and so I need you to do that. And that's what it's just, and for everybody else listening out there, this is what I'm talking about is that, he's sitting there, he's making the connections, his eyes are darting from number to number. But if you're listening to this with your eyes closed, you have no idea what he's talking about. All right, you just heard general directional trends. You don't have a sense of the magnitude. And that's why, if you really want to do a good presentation, practice with your teammates and ask at least one of your teammates to not look at the presentation while you're talking and see if they can follow you. Because I think that's actually a good mark of a presentation is that I can almost kind of visualize what I'm hearing you say. And so that's the part that I need you to make sure you add on when you go through this analysis. That's why you need a from and a to.
That's fair.
Okay. But keep going. You're otherwise doing a good job.
Okay. I guess, yeah. So with pre-tax ROIC, again, in particular, we see that in 2015, the ROIC was 27.7%. By 2017, it was 19.6%. Hence, again, most of the decline was in that period. And so again, to explain that, we can look at operating margin and invested capital to sales. With operating margin, we see that it declined by 26.5% over the period. In particular, in terms of magnitude, it declined from about 19 cents per dollar of sales to 14 cents. It's about a 5-cent decline in total. That decline was relatively steady. We do see though that there was about a 2.5, almost 3-cent decline in operating margin in 2018. Again, that's a point of focus to look at. So this is definitely a factor to consider for pre-tax ROIC. It's driving the decline in pre-tax ROIC. We see in invested capital to sales that this increased by 26.3% over the period. In particular, again, in magnitude, it increased by about 17 cents per dollar of sales over the period. Most of these changes were in 2016, it jumped about 6 cents, and 2018, where it jumped about 12 cents. Again, those are years to look at and try to figure out what's happening. This is, again, another factor. And so this leads to say that all of the drivers we have to the far right need to be looked at to figure out what's happening to ROIC. Look at the drivers for operating margin. Gross margin improved by about 1 cent. SG&A went up by about 5 cents over the period. This was steady. Depreciation went up by about 1 cent. And so from that, we see that depreciation and gross margin, the effects of those cancel each other out. We see that in this case, the increase in SG&A by about 5 cents is the primary factor that's driving the decline in operating margin. Looking at invested capital to sales and those drivers, the working capital to sales went up by about 0.5 cent. PP&E to sales went up by about 23 cents. And in particular, it jumped in 2018 by about 13 cents. Intangibles to sales went down by about 4 cents during this period. And so the clear driver here is PP&E to sales. The effect of that more than counteracts the decline in intangibles to sales. And so this is the primary driver. That is that they're spending, the invested capital to sales increased over the period because they're spending more on PP&E.
Okay. All right. Again, I think that the numbers were helpful. And as I said, what we all need to practice on is how we can turn this into a little bit more of a story. So just, reflecting back on what do you hear as you talk about the numbers, what are we noticing in the story of Delta? And the story of Delta is that their ROIC declined over 5 years from 17.5 to 12. And it did it primarily because the pre-tax went from 27 to 16. And what was driving the pre-tax down was a combination of lower margin and worsening productivity. The lower margin went from 19 to 14. And as you pointed out, it kind of bottomed out at 11.8 in 2018, rebounded to 14, but it was still a 5-year decline of margin eroding each year. And what seemed to be eroding the margin more than anything else was spending in SG&A, which went from about 81 cents to 86 cents over the 5 years, right? And a big bump between 16 and 17 from 82 to 86. That's really when they started spending more in their SG&A. Simultaneously, their productivity was worsening. They went from spending 69 cents in the dollar in 2015 to 87 cents in the dollar of invested capital sales by 2019. And again, the big jump appeared to be between 2015, 16, and 17, going from 69 to 76, 74, and then the really big jump was 74 to 87 between 17 and 18. So what caused that big jump in invested capital sales between 17 and 18, going from 74 cents a dollar to 87 cents a dollar? We can see it's the PP&E. It went from spending 65 cents per dollar of PP&E on PP&E in 2017 to almost 77 cents per dollar in 2017, right? So context, if we look it up, what's Delta doing? Probably buying, they're basically enhancing their fleet. They're bringing out a bunch of new planes. They're retiring the MD-80s, retiring the old planes, and they're replacing them with expensive new planes. So as they are putting in new planes in the fleet, and particularly these are more expensive planes, PP&E is going up, right? And that's what we're seeing trending between 15 and 19. Simultaneously, there's some margin pressure, right? We're seeing that margin pressure particularly acute in 18, but over 15 to 19, the margins have been eroding because they're spending more on SG&A and they're spending more on the depreciation, 4.5 cents to 5.5 cents on the newer planes that they're bringing on into their fleet. So just kind of layering in some context as you guys practice more and more, we'll start to bring this into a story and bring it alive about what's really happening with Delta Airlines. Other thoughts, questions, comments about this tree? And like I said, when you do your summary, it's left to right, the analysis, summarize right to left. Your final summary. So SG&A, which went from...
Sorry, I'm not sure.
Sorry, Alexa. Which went from 81 cents in 2015 to 89 cents, or sorry, 86 cents in 2019, was the primary reason the operating margin dropped from 19 to 14 over that 5-year period, which was the primary reason, along with the worsening invested capital, why the pre-tax ROIC went from 27.7 to 16.1. So just kind of work backwards with the high level after you did the forward walkthrough. All right. What about the CFI? What can we learn and say about the airline CFI during the same 5-year period of time? Somebody else want to try and tackle this one?
Yeah, I can pick up the first section.
All right. Why don't you go ahead and give it a shot?
Awesome. So we noticed right off the bat that we have a free cash flow of $8,392,000,000 and $500,000. So essentially, our analysis will be rounded around where that money is being allocated towards. The first thing that I like to look at is the CapEx with regards to depreciation. So we'll notice that we have capital expenditure over depreciation of 238%, indicating large potential for growth. And then moving into our gross investment, we see that, our investment rate, we see it's at 73%, which is calculated through our gross cash flow of 32,994,000,000 divided by our gross investment, which is 24,054,000,000. And then we'll notice that our free cash flow before goodwill is about 8,939,000,000. And then including that investment into goodwill and intangibles rounds out to about 8,392,000,000.
Okay. I appreciate the highlights. One thing is you had your ratio for the investment rate flipped. It's actually gross investment divided by gross cash flow.
Oh yeah, I'm sorry. Yeah.
That's okay. I know we're all learning these ratios for the first time, but I guess just a couple other highlights. So this was good start. That I would just, think about what are we seeing with Delta? I mean, first of all, what you're seeing with Delta is pre-COVID, it was a completely different story. Like this airline was really spending heavily to grow, right? Which is just all the more tragic financially, besides the personal cost of COVID, of what you could start to see in the airline industry. The airline industry was actually not expecting COVID and obviously had been investing as if they were going to see future growth. And Delta was investing a lot. You can see that with their CapEx to depreciation ratio, which has been averaging 238%, but peaked in 2018 at 433, and it was even double depreciation in 2019, 201%. So another thing that you can see is that their profits have been, steadily increasing, particularly since 2017 when they brought them down at $3.5 billion to put the $4 billion to almost $5.1 billion, which is the most they've achieved over the 5 years in 2019. So things were starting to go really well for Delta on the financial side, and that's when they kind of hit their ditch. But nonetheless, the other big headline is they didn't really do any major acquisitions. If you look at the investments in goodwill and intangibles, 540 million, I mean, almost all of it was either in 15 or 19. They had two minor acquisitions, nothing major in the 540 million relative to the 8.9 billion of free cash flow. So obviously, if we did our research, we could figure out who those two investments were. But generally, this was an organic growth story in the airline industry. All right. So what did they do with the 8.4 billion of free cash flow? Who wants to go next on that part? What happened next? They got 8.4 billion of free cash flow. What happens next?
I mean, I can take this section as well.
Thank you. Keep going.
Awesome. So we noticed a net operating loss of 253 million on non-operating assets. And so this is obviously going to take down that free cash flow and decrease it. So we also noticed that there's a decrease in excess cash of 559 million, which is assumed that they're taking it out in order to help pay off anything that they might need to in the third section. And then we also notice a decrease in net non-operating assets, indicating that they made money selling off some non-operating assets, which gives us our CFI of 35 million, which is going to be paid out in that last section. I can just go ahead and explain the last section as well.
Yeah, the only thing I would just add is that, magnitude, if I really want to understand how to get from 83.92 to 14,435.
Yeah, highlight the magnitudes.
The big change was the 57.40.
Yeah,
that was the big change. But otherwise, exactly. Good job. Keep going.
Okay. Awesome. And then so we'll notice that the money from our CFI is being allocated towards our after-tax interest expense. of 1,260,000,000. Our retirement related liabilities, which is 6,686,000,000. Our common dividends paid out for 3,488,000,000, and our shares repurchased of 10,080,000,000. And so you'll notice that the CFI wasn't sufficient in order to pay back all of this. So they took out a debt of 7,594,000,000 to help pay back all of this.
Yeah. So that's good. So one thing has popped up with this airline that we really hadn't seen in the other companies we've done so far, which is, are they borrowing the debt to buy back the stock? Like, what are they really borrowing this debt for?
To grow, particularly in 2018, we see that their CapEx is 10 billion. So again, a lot of the debt. And we see that their CFI is negative in 2018. So that indicates
So in
that
2018, they actually needed the debt to actually fund some of the growth. But the other thing that they're doing is what? In the other years.
Buying back shares.
Well, I was saying not just buying back shares, but they're paying off a lot of their retirement related liabilities. So that's the point. Like these older companies, basically had pensions. Now companies are switching away from pensions to 401ks, but Delta had a pension. And these pensions were underfunded. So basically Delta has been funding their pension, their underfunded pension, to the tune of $6,686,000,000. That's what that retirement related liability line is all about. So, they're playing catch up on an unfunded pension liability. And it's pretty big. Matter of fact, they made a huge payment in 2017 of almost $3.6 billion. But their debt is a little different story. Their debt was, a lot of that debt was, as you pointed out, during the negative free cash flow of 2018, when they were buying a bunch of aircraft, $10 billion worth of aircraft. They financed a lot of that. The other part of the debt was probably to help them, since they didn't want to buy back shares, to help fund that retirement related liabilities in some of the other years. So a little different story about what Delta's doing with their debt than say what we had previously seen with say the McDonald's or other companies in the world. They weren't as much trying to juice the earnings with the share repurchase as much as they were actually funding, either paying off their liabilities or buying back or buying planes, which they actually primarily did in one of the years. So just another little highlight that would be different for Delta than what we have seen. Back to the story of Delta. All right, questions about any of the CFI, the sections, how to go through it, what we need to be talking about, how we're tying it together. As I said, you're going to be doing this in general dynamics. Since you've already done an EIC, you should have a little bit more context on why some of these numbers are changing. And again, if you see some big changes, when I ask my question to each of the teams at the end, just look at this. Why would the reinvestment rate go up 164% in 2018? What was all that capital expenditure for? That would probably be one of the questions. If I did want to ask about who they bought, they did some minor acquisitions in 2015 and or 2019. Who were their minor investments? Who did they buy? Or in Delta's case, we saw a dip in profitability in 2017. What might have been behind their dip in profitability in 2017? So if you're thinking about it, it's not that I'm going to ask gotcha questions. I'm going to be looking at the same data you are. And if I start noticing an interesting data point trend, that's probably what I'm going to ask you guys about, right? When I'm looking at this analysis. But as I said, make sure you walk through the sections, make sure you use the numbers, make sure you are telling a story, keep to your time. You got to cover both of these in about 5 minutes each. So if you run out of time, that's very bad. Put everything in your PowerPoint. You can have the same or different people present that presented versus the first time. Remember, you don't have to have everybody present. You're presenting this as a team for a team grade. And again, the presentations will be 2 weeks from today, the day you get back from spring break. So knowing that you guys are all going on spring break, I would just simply say, be safe with whatever you do. I'm giving you Wednesday's class to work on the general dynamics presentation. So hopefully you guys can put that to bed and be ready with your presentation before you go out to spring break. And I've just moved the presentation, doing it right after spring break. But just remember, when we come back, we're going to do these presentations. So Friday, like I said, make sure you've made in your final stock track trades or Bloomberg Trading Challenge trades. The Monday you come back, we'll do these presentations. The Wednesday you'll come back, you will do your midterm exam individually. And then we'll start on the valuation part of the class the following week, which is the third section of the class. And that's where we get into our heavily Excel modeling part of the class. So that's kind of what's up on the horizon. Any final questions for today?
Just to clarify, are we gonna have Zoom breakout rooms on Wednesday? Or are these just like? Because you
No,
mentioned
I'm not, there's not even a Zoom. You guys are on your
Okay.
own meeting on Wednesday. So you'll notice I'll cancel the Zoom classes themselves. So the next time I'll see you guys is 2 weeks from today. And so again, have a safe and enjoyable spring break wherever you go. Remember, there is still a virus out there, but in any event, we'll be back. Our next live session will be 2 weeks from today when we'll be making your presentations. Turn in your PowerPoints the morning of.
Thank you.
All right, that's it.
Thank
All
you.
right.
Take care.
Take care, everybody.
Professor.
Yep. All right, bye-bye.